Hello everyone, good morning and a very warm welcome to our webinar today. This session is Pension Calculations and it is part of our Pensions Discovery Digital Badge series. We'll be telling you more about how you can earn your digital badge towards the end of this webinar. My name's Duncan, I'll be hosting and presenting the session, and I am joined in the background by my colleague Sarah, who is standing by waiting to answer any of your questions. Let's now take a look at what we'll cover in the webinar. So we'll start with an introduction to pension calculations, explaining what settings specifically will affect a pension calculation and where to check these settings in your payroll software. And some of this will be recapping the information that you might have seen in our pension basics session and also the salary sacrifice webinar that we ran on Wednesday. We're then going to work through some example calculations, and we're going to show you that same scenario in Sage 50 Payroll. So you'll understand how the pension is calculated, and you'll also see that very same example in the payroll software with a scheme using those same settings. Once we've been through a number of examples, it'll be over to you. So your turn to get your grey matter work in this Friday morning, and a couple of pension calculations for you to try at home. So if you've got a calculator to hand on your phone, anything like that might come in handy for that section. So let's get things started by giving you an introduction to some of the factors that would affect a pension calculation. So we've listed some of these points on screen now. And the main things that will influence the pension calculation are your employee's pensionable earnings. So it depends how your scheme works. That might be just the basic pay, or it could be the qualifying earnings between lower and upper thresholds. The pension contribution rates for both employee and employer. Whether your pension scheme deducts before or after tax. We'll talk more about that a little bit later on. And whether your scheme uses qualifying earnings for pensionable pay, or whether it's a different definition of pensionable, such as basic pay only. The last thing to factor in is whether your scheme is a salary sacrifice scheme, because that will work slightly differently to non-salary sacrifice pensions. And today we're going to go through a number of examples covering different setups, and hopefully one that'll be similar to your own pension that you use. So when we're talking about pensionable earnings, this is the value of the payments that will be used to calculate percentage-based pension contributions. And it is important that your pay elements have been set up correctly so that the calculations are done accurately in line with the pension scheme rules. So you can review your pay element settings and you can check if they're set up to be included in qualifying earnings, whether they're pensionable for both main and additional voluntary contributions, and whether that payment is included in salary sacrifice pension calculations. Now, a couple of examples on the slide. The one on the left-hand side for basic pay has been set up to be fully pensionable. So basics included in qualifying earnings, it's included in pension calculations and also salary sacrifice pensions in this example. Whereas the expenses payment that you can see on the right-hand side, it's the non-taxable payment that we use to reimburse expenses, is not pensionable. So for those settings, you'll see that all of those boxes have been cleared. And in the demo, I'll remind you how to check your pay element settings and also how to run a handy report that will show you all of those settings in one place. We also need to know about the tax relief arrangement that your pension scheme uses. So if it's not a salary sacrifice scheme, you will need to know if the employee pension contribution is deducted before or after tax. And this will all depend on the tax relief arrangement that your scheme uses. So if you're not sure, you should always clarify this with your pension provider. So the two tax relief arrangements are deduct before tax, which is known as a net pay arrangement. And this is where the employee's full contribution is calculated from the pensionable earnings, and that deduction is made from the employee before tax is calculated. So if you've entered a 5% contribution, that full 5% will be deducted from your employee's taxable pay. And the other tax relief arrangement is deducting after tax, which is known as a relief at source arrangement. Now, this is where the employee's contribution is actually reduced by 20%, which is the basic rate of tax, and that amount is deducted after calculation of tax in payroll. Now, the tax relief is claimed back from HMRC by the pension provider at the basic rate at 20%. So through payroll, if you had a 5% contribution set up, in effect, only 4% would be deducted. And then the tax relief, as I say, is claimed back separately. Now, we did mention qualifying earnings, and since the introduction of auto-enrolment a number of years ago now, many schemes will use qualifying earnings for pensionable pay. So the definition of qualifying earnings includes salary, wages, commission, bonuses and overtime, as well as all of the statutory payments. But when it comes to calculating the contributions, the pensionable pay are the earnings between lower and upper thresholds, which have been set in legislation. Now, these thresholds are built into your payroll software. Payroll will do the calculation for you, but for you to understand how that calculation is being done, you'll need to know that the lower and upper thresholds apply in these calculations based on the employee's pay frequency. So for monthly, for example, lower threshold is £520 and the upper threshold is 4189. Top tip, pretty much all payments that are subject to tax and national insurance do count towards qualifying earnings, but if you're ever unsure whether a particular payment should be included in your pension calculations, it's best to check that out with your pension provider. So the other factors that affect pension contributions can be checked within the pension scheme settings, which we're going to take a look at in a quick demo. So I've highlighted them on the slide here. There's the setting to use qualifying earnings for pensionable pay. You've got your salary sacrifice scheme setting. You've got the employee and employer contributions, which are usually set up as percentages. And then the tax relief setting is found on the employee tab, because tax relief refers to employees' contributions. So I want to show you some of this in Sage Payroll. So I'm just going to bring the slides down for a moment and we'll jump into the payroll software. So first thing we'll take a look at is some pension scheme settings. So if I go to my company tasks and click onto pension schemes here on the left-hand side, I've got 3 schemes set up for today's demo, which we are going to look at in a bit more detail when we go through the worked examples. But if I just show you the first scheme by clicking Edit, where it tells me it is in use by at least one employee, we can see here on the Details tab, we've got a description of our scheme. We've selected the box. So this scheme does use qualifying earnings for pensionable pay. It's not a salary sacrifice scheme, so we don't have that box ticked. And when I go on to the employee contributions, our default contribution is 5% of qualifying earnings. And because it uses qualifying earnings, you can see it's automatically ticked all of the statutory payment boxes. But the tax relief for this scheme, I need to check this setting, is it's a relief at source arrangement, so it's deducted after tax. And that is the reason why I have not ticked the deduct before tax checkbox. And remember, it's your pension provider that will be able to confirm what tax relief arrangement your scheme uses. So we've then got our employer contributions. And again, we're automatically including statutory payments in that as it uses qualifying earnings. And of course, you can enter provider details on the provider tab. We'll take a look at some of the other schemes, as I say, when we go through the examples. For the pay element settings, these can be checked for individual payments. If you go to the company tasks and then click pay elements. So examples I showed you on the slide, our basic pay is fully pensionable, so it counts towards qualifying earnings. Also to pension contributions for schemes that don't use qualifying earnings, and it counts towards salary sacrifice calculations. If we compare that, say, to bonus payments, This one has just been set up as qualifying earnings because it meets that definition. But for any schemes that don't use qualifying earnings for pensionable pay, we have set this one up to not be pensionable. So it won't include bonuses in pension contributions or salary sacrifices. But remember, for schemes that do use qualifying earnings, it will be included. So they can all be checked from here. And you might have seen this at some of our other webinars, but the payment types report is a handy way of checking all of the pay element settings. So if you go to the reports option at the top, I've got it added to my favorite. So it's payment types, actually lives in the company folder, just down here, payment types. And you can see if I just run this on screen, just show you the preview. It's then listing kind of all of my payments, and I can very quickly check the pension settings. So basic pay is pensionable, other payments are not. Got everything except for expenses being qualifying earnings. And again, I just have the basic pay set up for salary sacrifice. So this should help us understand how the calculation is being done when we take a look at that later in the webinar. So those are the key settings and a bit of a reminder of where to check them. But now we're going to move on to a little bit of maths. I'm going to run through 4 example calculations with you, and then we've got a couple at the end for you to try at home. So the way it's going to work for this one is I'll run through the calculation on screen, and then I'll show you that exact same example in Payroll so that you can see how that works in practice. So let's start off with a simple example. So example 1 is a pension scheme where pensionable earnings are basic pay only. So this one is not using qualifying earnings, it's just basic pay that's pensionable. We've set the employee contribution to be 6% and the employer contribution to be 8%. And the tax relief for this one is that it's deducted before tax. In other words, it's a net pay arrangement. Now for this calculation, the employee's total gross pay this period is £4,000, but that's made up of £3,500 basic plus £500 bonus. And the pay frequency for this employee is monthly. So when we do the calculation, first thing to do is to establish the pensionable pay. So we know that in this example, it is basic pay only. So £3,500 is pensionable. To calculate the employee contribution, we take the pensionable earnings and we multiply by 6%. So 6% of £3,500 is £210. So that will be deducted before tax from the employee. And then the employer contribution is the pensionable earnings times 8. And in this example, that would be £280. So let's take a look at that same example in Payroll. If I just bring Payroll up on screen, I'll show you the pension scheme setting first. So it's this scheme I've set up that uses basic pay only. So we have not ticked the use qualifying earnings for pensionable pay box. And we've got default contributions of 6% for the employee, deducted before tax. So we've got that box ticked. And we've got our 8% for the employer. Now this has been assigned to employee number 1. So if I go onto the pensions tab, click onto manage schemes, you can see it's scheme number 3. And we've stuck with the default percentages. So if I go to my payroll tasks and take a quick look in enter payments, I've got £4,000 gross in total, but only £3,500 of that is salary. And then to check the contribution, I go to the summary tab. So this is our £210 being deducted from the employee, and it's deducted before tax. So notice that the taxable gross pay has been reduced compared to the total gross pay. And then to check the employer's contribution, I click this employer's button, and you can see that the employer is contributing £280. So that is based off the basic pay in this example, and it's ignoring the £500 of bonus. So pretty straightforward for that first example. Let's move on to the next one. So for this next one, we have a pensionable scheme, a pension scheme where pensionable earnings are qualifying earnings. The employee contribution is 5% and the employer contribution is 3%, so the current minimum contributions. And the tax relief for this pension scheme is that it's deducted after tax. So it's a relief at source arrangement. Because it uses qualifying earnings, the calculation will use earnings between lower and upper thresholds. So I've put those thresholds up on the slide as well. And the gross pay for the employee is £2,500. All of that is basic pay, which counts towards qualifying earnings. And the pay frequency in this example is monthly. So step one is to establish the pensionable pay. And because this one uses qualifying earnings, and the total gross pay is below the upper threshold for monthly paid employees, all we need to do is to deduct the lower threshold from the gross pay. So £2,500 minus 520 leaves us with pensionable pay of £1,980. The employee's contribution is 5% of the pensionable pay, which is £99, but as it's deducted after tax, we need to reduce that by 20% or multiply it by 80%. 80% of £99 is £79.20. So that will be deducted from the employee after tax, and the tax relief is claimed back directly from HMRC and put into the pension pot. The employer contribution is slightly more straightforward. It's the pensionable pay, 1980 times 3%. So that would be £59.40 that the employer is contributing. So let's take a little look at that one in payroll. So this was the scheme that we looked at earlier in the demonstration, and it's been assigned to employee 2. So it's a scheme that uses qualifying earnings. We've got a 5% contribution for employee, 3% for employer. So if you're in the employee record, you can check the scheme settings by clicking pension information. We can see it's deducted after tax, and the calculation applies to qualifying earnings bands. So let's just jump into enter payments. And you'll see we've got the salary entered, £2,500. And checking the summary tab, our pension contribution is £79.20. That's deducted after tax. So they are paying tax on their full salary, as opposed to the scheme we looked at in the previous example. And the employer's contribution, in this case, is your £59.40, so 3% of the pensionable pay. Now, if there were any additional payments, such as bonuses in this example, because bonuses count towards qualifying earnings, you would see that the pension contributions increase. So this scheme is using all qualifying earnings between the lower and upper thresholds. The calculation we looked at is this one just here. So that's an example there using qualifying earnings. I'll move on to the third one. So mixing it up slightly for this one. We still have a scheme using qualifying earnings, and we're using the same contributions, 5% for the employee, 3% for the employer. Tax relief is deducting after tax again, so it's a relief at source arrangement, and this time we would be looking at the weekly thresholds because the employee is being paid weekly, and their total gross pay in the period is £1,040, which is £540 of basic plus £500 of commission. So when we work through this one, to calculate the pensionable pay, we take a look at the lower and upper threshold for weekly, and we can see that the employee's total pay is above the upper threshold. So the pensionable earnings are just the earnings between the lower and upper threshold. So if we do 967 minus 120, it means our pensionable pay is £847. The employee's contribution is 5% of the pensionable earnings, which is £42.35. But we need to reduce that by 20% because it's deducted after tax. So we take 80% of that figure and it gives us £33.88. The employer contribution is the pensionable pay times 3%. So for this one, that's £25.41. So let's check that one out. So I'm going to select a weekly paid employee this time. Employee number 8 is the one we're using for this example. We've assigned them to the same scheme as we did for the last example. So I'm going to go straight into the enter payment screen. And you can see here's the basic pay, £540. We've also got the £500 commission, giving a total of £1,040. And on the summary tab, the employee's contribution was the £33.88. And the employer's was £25.41. Now, in effect, that's the maximum contribution for a weekly paid employee on this scheme because their earnings are already above the upper threshold. So even if that commission was doubled to £1,000, you'll see it hasn't made any change to the pension contributions. If the commission was less, bringing their gross pay below the upper threshold, that's when you start to see the pension contributions reduce as well. So this has been reduced accordingly in the same way as the employer. But that's how it's working out for a weekly paid employee who for this week is earning above the upper threshold. So I'm going to go through one more with you before it's your turn. So example number 4. For this one, we're using a pension scheme where basic pay are the pensionable earnings, but this one is a salary sacrifice scheme. So the employee has a salary sacrifice of 5% of their basic pay. The employer is going to contribute 3% on top of that salary sacrifice amount. And there's no tax relief as such because there's no employee contribution, but because they have a salary sacrifice, it's reducing their gross pay before calculation of tax and national insurance. Gross pay for this period is £2,750, and that's all basic pay, so it's all pensionable, and it's a monthly pay frequency. So first of all, pensionable pay, pretty simple, £2,750. The employee's salary sacrifice amount is 5% of that pensionable pay, which is £137.50. The employer contribution is the 3% they put in themselves, which is £82.50, plus the amount of the salary sacrifice, £137.50, which gives us a total of £220. So it's all employer contributions because the employee has a salary sacrifice instead of a pension contribution. And it is laid out slightly differently on the slide as well, on the payslip. So it has a salary sacrifice deduction, and then you'll see the kind of total employer pension. Now, there is also a setting where you can include employer NI savings in the employer contribution. So if that was enabled, you can see how it gets calculated. So it works out the employer NI saving on the salary sacrifice amount, and then that is then added to the employer contribution. So we'll run through this one on screen in Payroll. So it's employee 3 in this example. Pension scheme we've put them on, it's a salary sacrifice pension. So we can see we've got the box ticked to say it's a salary sacrifice scheme, but we're not using qualifying earnings. In this example, got the 5% sacrifice, and I've got my 3% employer contribution. So we'll go into enter payments. There's the salary amount. Salary sacrifice shows at the bottom of the screen. So you can see it has reduced the gross pay. So they're only paying tax and national insurance on this reduced amount. On the summary tab, there is no employee contribution. They've had a salary sacrifice instead. And when I click employers, that's where we're seeing the full contribution, including the salary sacrifice amount. So in effect, that £220 is 8% of the pensionable pay. It's a 5% salary sacrifice and the 3% employer contribution. And just to show the difference between that and a non-salary sacrifice scheme, I'll just show you the pay slip for a couple of employees. There we go. So the top one, non-salary sacrifice, so they've got employee and employer pension showing on here. Second one is a salary sacrifice, so the negative payment to show the amount of the sacrifice. The employer contribution only is the full amount. And then you can see there in the box at the bottom the impact of selecting the option to add the employer NI saving. So hopefully you've followed along with that, and it would be great if you could join in with us for this one. And we're going to give you the chance to run through a couple of calculations. We've got 2 lined up for you. So work out the pensionable pay, the employee contribution and employer contribution. And once you think you have the answer, if you pop it into the Q&A, we'll see whether you've got that right. So this is your first one. Your pension scheme uses basic pay for pensionable earnings. The employee contribution is 5% and the employer contribution is 7%. The tax relief is that it's deducted before tax, so it's a net pay arrangement. And you're doing the calculation on gross pay of £3,000, which consists of £2,500 basic plus £500 commission, and the employee is paid monthly. So what we're asking you to do is to work out the pensionable pay and then to work out the employee contribution and the employer contribution. And when you think you have the answer, pop it into the Q&A and we'll come back and we'll go through the calculation. So I'll give you maybe a minute or two to take a look at that example. Okay, so we're starting to see some good answers coming through in the Q&A there. I think most of you have got that right as well. So let's take a look at how that one is calculated. So first of all, the pensionable pay, with it being basic pay only, was £2,500 in this example. The employee's contribution is 5% of £2,500, and that's £125. Because it's deducted before tax, the full percentage is deducted from the employee. The employer contribution, 7% of the basic pay, is £175. So I can see that a lot of you got that right. Looks like a few of you may have applied some qualifying earnings bands, so hold that thought for the next one. But that is the answer on screen. So well done to everyone that got that one right. Let's have a look at your question 2. So in this one, your scheme uses qualifying earnings for pensionable pay. So that's earnings between the lower and upper threshold. The employee contribution is 5%. The employer contribution is 3%. The tax relief is that it's deducted after tax. It's a relief at source arrangement. And the gross pay for this period is £540. That's all basic, so all counts towards qualifying earnings, and the pay frequency is weekly. So we're going to ask you to do the same thing. Work out the pensionable pay, calculate the employee contribution, and also calculate the employer contribution. So again, a couple of minutes for this one. And when you think you've got the answer, pop it in the chat and we'll see whether you were right. Okay, so again, we're getting some answers through on this one. A bit of a mixed bag. We've got some good ones on there. And I think we'll start going through the calculation, just in the interest of time. So let's start with pensionable pay. So because it uses qualifying earnings and they're paid weekly, the £540 they've earned is below the upper threshold. We just need to deduct the lower threshold. So it leaves the pensionable pay as £420. So remember, it's the lower threshold, not the earnings trigger, that you need to deduct to give you the pensionable pay. Employee contribution. So 5% of the pensionable earnings is £21, but because it's deducted after tax, that needs to be further reduced by 20% or multiplied by 80%. So the employee contribution is £16.80, which loads of you have got, so well done. And the employer contribution, £420 times 3%, is at £12.60. So all of the workings for the examples that I showed earlier and for the 2 that you've had to go at are available on the handout. So if you want to look through any of those later on, do feel free to download those before you leave. And a big well done to everyone that got those questions right or even had a go. And the good news is Obviously, Payroll does all the calculations for you. So as long as you've set up your pension scheme correctly and your pay elements, you don't really need to worry about this. Always useful to know how it's done though, behind the scenes. So that has actually brought us to the end of what we're going to cover in today's webinar. But as always, I'd like to just spend a moment to run through some of the further support that is available. So as you know, this is one of the sessions that counts towards our Pensions Discovery badge. And if you attend at least 5 different sessions plus our quiz that we're running on 2 different dates, you would qualify for the digital badge. And to tell you a bit more about this, I'm going to play you a quick video message from my colleague, Matt. So I will see you after this video.
Get ready to earn your Pension Discovery badge with Sage 50 Payroll. Join us for our fantastic new webinar series where you'll learn everything you need to know about pensions to get you ready to confidently process pensions for your employees. With 7 live sessions and a fun learning quiz in the last session. Whether you're new to pensions or a dab hand, we have something for everyone. Here is what we've got lined up for you. Make a strong start to your pension processing with foundational knowledge on the basics of pensions and salary sacrifice pensions in Sage 50 Payroll. Explore how pension contributions are calculated and how your employees are assessed for automatic enrolment. We'll also take you through our 3 most popular sessions: navigating enrolment, getting started with pensions module, and using pensions data exchange to send your pension data to your provider with ease. And lastly, backed by popular demand, test your knowledge with our Pensions Discovery quiz to see what you've learned across the sessions. Now, how do you get your hands on your Pensions Discovery digital badge? Simply attend 5 out of 7 of the live sessions and our quiz to earn your badge. And don't forget, you get free access to our new Accredible portal to manage your badges, so you can quickly and easily share your badge on socials for everyone to see. Don't miss out. Secure your spot and join us for an unforgettable learning experience by signing up at sage.co.uk/webinars. We'll see you there.
So that's just a bit more info on the digital badge. We're running each of these sessions twice, so if you've missed any of the first 2, do look out for the repeat sessions. You can sign up for all of these free of charge at sage.co.uk/webinars. Just to let you know as well, you can find further help with all things payroll from our online help centre. Simply click the help options in Sage 50 Payroll or visit sage.co.uk/help and follow the links for Sage 50 Payroll. So you can search our knowledge base, read the support guides, see what's coming up in terms of other webinars, and you'll find all contact details for our support team should you need them. Another fantastic learning resource is Sage University, which you can access at sageu.com. So do check out the e-learning, certification and bite-sized learning courses available for you to dip in and out of to brush up on your payroll skills. So we've got a few minutes left of the scheduled time, so we will stick around just in case there are any final questions that you'd like to send through. If you'd like a copy of the handouts, don't forget to download them before you leave from that piece of paper icon. And just to let you know, we will send you a follow-up email, which will include a link to the recording of today's session. So watch out for that in your inbox arriving later today. Last ask from us is that when you leave the webinar, if you wouldn't mind completing our survey, we'd very much like to know what you thought of today's session and any suggestions that you might have for other webinars or perhaps improvements to our service. We do read all of your comments and we do our best to act on those to improve these sessions moving forward. So look out for that link as well in your follow-up email. So I'm going to pop onto hold for a few moments, onto mute, just check on the questions, and then I'll come back to you when we're about to close the webinar down. I'll speak to you soon. Again, everyone, as we are nearly out of time and we haven't had any new questions come through in the last couple of minutes, we are going to call it a day there. So thanks so much for joining us at the webinar today. I hope you enjoyed it and you found it useful. We'd love to see you on some of our other pension sessions so that you can get your very own digital badge. So get yourself signed up if you haven't already. On behalf of myself and Sarah, thanks again for joining us. Have a great weekend. And we look forward to seeing you again in the near future. It's goodbye for now.